Ed, good to have you. I think you previously identified 65 panic attacks during the bull market, this long bull market, and you believe that coronavirus may be the 66th. Is it fair to say it is?
Oh, absolutely. No doubt about it. As a matter of fact, we first started to talk about the possibility that this would be the 66th panic attack on at the first day of trading on February, and that was after the late January sell-off, but we just said that it could be. And then at the beginning of February, we actually listed it as a panic attack number 66. The question is whether it's just a panic attack, which means it'll be followed by a relief rally and is actually just a great buying opportunity, or whether this is the beginning of a bear market. I'm still in the panic attack camp.
You are. What about the impact of the fear of the virus, which clearly is impacting economic activity around the world and causing a potential recession?
Well, the pandemic of fear is really what's driving this stock market downwards. The reality in terms of the data is that so far COVID-19, as the virus is called, is much less severe than just a typical flu season. And yet the fear of COVID-19 is spreading faster than the flu that we see on a regular seasonal basis. So there is a lot of fear, and I think part of this fear is being fueled by the government reactions, which have been extreme. But then again, the fact that the governments are acting with these quarantines and rapid-fire announcements that we all have to be careful. People are flying less. People are interacting less. Businesses are canceling meetings. So this pretty significantly, I think, increases the odds that this too shall pass. Just the way other flu viruses, coronaviruses, have passed, like SARS and MERS and so on. So if we start to get more evidence of that, and there's, nobody trusts the data coming out of China, but there's some evidence that maybe the worst is over there. I think as we see that these government actions are working, the pandemic of fear will abate and the market will come back.
So what type of earnings decline are we looking at right now in this market?
Yeah, very, very important question, because as you know, last year we had a great melt-up really in the stock market. It started right after Christmas back in 2018. The PE multiple back then was 13.5, and we soared to like over 40%, up to 19 on the forward PE multiple, and now we're down to 17.5. We had a PE-led melt-up because the reality is earnings. We had an earnings growth recession last year. There was no growth in earnings for all practical purposes. Part of that was it was tough to compare earnings last year to the year before, which had this big boost from the tax cut. But the bulls, including myself, were expecting that this would be a good year for earnings, and everything started to kind of line up that way. The economic data for January has been very strong, broadly speaking. But then the virus hit, and it looks as though we're going to continue this earnings growth recession, which I guess is actually an optimistic outlook, because some people would say that we're going to have just an outright recession with earnings taking a dive. So to your point, analysts have been cutting back earnings expectations pretty dramatically, and now they're expecting basically close to zero in the first quarter, year-over-year percent change.
First quarter, but I mean, shouldn't we be talking about beyond that?
Well, I'm watching the quarterly estimates by the analysts. You're absolutely right, and what's happening is they are lowering their growth estimates for all 4 quarters of this year, but they're still sequentially looking for an increase. So they tend to be optimistic, and they're not as fearful as maybe they should be. But I would expect the next few weeks we will continue to see them cutting their estimates.
So a lot of people know you, Ed. You're sort of famous for the bond vigilante kind of expression. Mm-hmm. We were just talking to Charles Delara, formerly of IIF. Is there a point at which you can have an equity-type vigilante situation to push governments to coordinate healthcare policies more, to push central banks to coordinate monetary policies, and potentially governments to act for fiscal action as well?
Well, one of the things that's disturbing about panic attack number 66 is This one, it's not clear that the policy response is out there that can really do much other than what it's been doing in terms of the healthcare response of governments, the quarantines, and the warnings. I heard that, I watched that you had a lot of conversation about the Fed cutting rates here, and they may very well be just forced to cut rates. But let's face it, the Fed can fix a lot of problems, and they've tried to fix a lot of problems, but this one they can't fix. I mean, you can't make the virus go away with pouring more liquidity into the economic system, and you can't make people go to work or fly for business if everybody is in panic mode.